It seems that in every session I've been in the last couple of days, there's been mention of the importance of accountability and transparency. It's been one of the key themes in the last decade for public companies, as we all know, starting with the corporate debacles of Enron and Tyco and the like, which led to an increase in the level of requirements in terms of accountability for public companies. And as organisations of public interest, not-for-profits were also being demanded more of in terms of accountability. And we've seen that. We've heard talk in the last couple of days from Imagine Canada in terms of their code of ethics, Kevin Donovan talking about the media's interest in the sector. And accountability and transparency can relate to a number of different areas, as we heard this morning from Mary Louise and Maggie, in terms of non-financial areas where this would be of interest. But given the importance of the management of resources by a not-for-profit organisation, financial reporting is a key part of that accountability and transparency requirement or demands that are being made of the sector, which is where us as external auditors come in. In terms of financial reporting, there are a number of areas where an organisation is likely to have responsibilities. Firstly, the financial information that's submitted with the T3010B, which, as Kathy said, is available through the CRO website. It's important to remember that it's not required that this information be audited. There is a basic requirement in terms of what gets submitted to CRO. In terms of this include a statement of asset and liabilities, revenue and expenditures, and also some limited notes. But CRO are not requesting full audited financial statements. But it is important to remember that this information is available to the public upon request, and therefore it is something for which the organisation will be accountable not just to CRA but to the public at large should they request this information. One of the other key sources is, of course, the year-end audited financial statements. I say audited. I'll talk a little bit later about some situations where there may not be a requirement for those statements to be audited, but those are important. For some organisations, they will be, as you know, will be provided on the website, although my work in the last few years in the area of accountability and transparency indicates that it's actually relatively few organisations who include the full audited financial statements. There's a question about whether this actually constitutes best practice, and certainly the direction that a lot of organisations are moving is to provide more of this kind of information, to include the full financial statements with all of the note disclosures. But as you know, generally there will be some kind of summarised financial information which is included in the annual report, which is made available to the public and donors. And then there may also be other financial reporting obligations which can be audited or unaudited, but I'm thinking in terms of funding reports that are requested by funders. Certainly I spend a lot of my time working with my clients who were requested by their funders, by their donors, to provide very specific audited financial information as it relates to specific funding streams, programs, etc. at various points. So those will be the main financial reporting requirements. Where do we as auditors fit in? Now, when I'm talking about external auditors, I'm not talking about the CRA audit, as was mentioned at lunchtime. I'm talking about an independent accounting individual or firm who's been engaged by the organisation to express an opinion on the financial statements. And it's important that we highlight that idea of independence because it is one of the key elements of the relationship between the auditor and the organisation. And that's independence in terms of business relationships, financial relationships, or personal relationships. And as an organisation, you would expect that your auditor would confirm their independence to you, to your board, to your members, at least on an annual basis, to confirm that they are independent in all of those ways. And if there is anything which they think might impact their independence, such as the provision of any other services, such as having a family relationship involved in the management or the board, then that should be declared to you as an organisation. Now, the auditor may also provide other services which would be part of a separate engagement, separate from the annual audit. For example, I've already mentioned with respect to funding agreements, carrying out specific procedures that have been requested by your funder to ensure that the use of funds has been in line with an agreement or a donation contract that you may have. Often we'll be engaged to look at the internal controls of an organisation. One of the responsibilities of an audit committee, as we heard yesterday in Don McCreacher's session, is that an audit committee has a responsibility of ensuring that they understand what the risks in terms of the financial information are to the organisation, and to the extent that there are risks, to make sure that there are controls and processes in place to ensure that those risks have been identified. So, for example, if because of the particular method of fundraising there is seen to be a specific risk of fraud, for example, of misappropriation of a certain kind of asset from a particular donation stream, then once that's been identified, a board of directors via its audit committee has a responsibility to make sure that there are systems in place to give a level of comfort with respect to those specific risks. And then another area which we do provide some work with respect to our not-for-profit clients is in the area of different types of engagements, whether it be review engagements or compilation engagements, and Bobbi will talk a little bit about that later in the session. But firstly, I'm always surprised, when I first got involved in this sector, I was surprised by the number of times I was asked by clients, do I need an audit? Why do I need an audit? Can I have a review instead? The need for an audit, it is a legal requirement, and it's dependent upon the incorporation of the organisation. So, for example, if your organisation is federally incorporated, then there is a requirement in the Canada Corporations Act that an auditor will be appointed by the members on an annual basis, and that an independent auditor will make a report on the financial statements. And the financial statements have to be prepared in accordance with what we call generally accepted accounting principles. That means the principles which have been laid down by the Accounting Standards Board for the preparation of financial statements. So there are very specific rules and guidelines given as to what accounting policies are appropriate, how items should be accounted for, and what items need to be disclosed in the financial statements. And we call that GAAP. There is some relief under the federal rules if all of the members agree, unanimously and in writing. Then if there is somebody associated with the organisation, whether that be a director or an officer, who is willing to provide this service for free or for a reduced fee, then you can get around somewhat that requirement of independence and engage that individual to provide the services for the organisation. The rules are a little bit different if you are incorporated in Ontario, where the only relief is available for organisations who have annual revenues of less than $100,000, whereby, again, you would need unanimous annual consent from all of the members. But in that case, you can do away with the requirement for an audit. So I find that that's one area that smaller organisations are not aware of their ability to do away with that particular expense. And that being said, it may still be required by funders. It may be still seen to be a prudent idea in terms of dealing with governance issues from the board of directors. They may still require an audit, but the organisation can have those discussions about whether they want to incur those expenses for the annual audit. In terms of the Income Tax Act, as I said, there are no requirement. The financial statements have to be issued, but there's no requirement that they be audited, or indeed that they be in accordance with GAAP. So those can be prepared on a cash basis or an accrual basis. There's not the same stringent guidelines as are demanded under GAAP. But the reality is, at this point, most not-for-profit organisations need audited annual financial statements. Things are changing, however. There's a lot of words on this, and there's a lot of legal jargon. But what's been happening recently is there has been reform of the Canada Corporations Act, which has been a long time coming. It hasn't been changed substantially since 1919. It's been various parties have been demanding change since approximately 1919, but it's taken until now to get any kind of meaningful amendments made. In June 2009, the new Canada Not-for-Profit Corporations Act, Bill C4, received royal assent. It still needs to pass some of the final stages before it becomes law, but it's expected to be in place in the next couple of years. Now, this makes a number of changes in a number of areas, and what I've included here is just some details with respect to some of the areas that you can expect to see changed. Not being a lawyer, I will not address those. This is just to provide some information. But there's two important things that have happened from my particular position as external auditor. The first is that what the new Act does is to split not-for-profit organisations into three kinds of organisations. The first are soliciting corporations, which are those who receive public funds. And the public funds that they receive are very small. The idea is that an aggregate over 3 years of $10,000. So that's public funds in terms of donations from the public, receipts from the government, or receipts from any other organisation which is also funded by the government. So any indirect public funds that are received. The idea is that soliciting organisations, being those that have more, they're more answerable to the public because of the funds that they received, going forward are going to be required to meet higher levels in terms of accountability and transparency. There will be some different rules for those organisations. The other two areas are religious corporations, and the information so far actually provides little guidance as to what to include in that category. And then the residual category is non-soliciting corporations. And there's a number of areas where there will be different regulation for soliciting and non-soliciting in terms of what the board composition has to be, how you can use the unanimous member agreement, etc., and the filing of annual financial statements. So there's a number of areas outside of what I've included here. However, from a financial reporting point of view, the important change is that for both soliciting and non-soliciting organisations, there will be options available as to the appointment of a public auditor and whether they need an audit going forward. So at certain levels, at certain sizes, there will be an option, instead of having a full audit, to have a review performed by your external auditor. And again, Bobbi, you'll talk a little bit about what that means in terms of the depth of work and the costs associated by that. When you look at the levels, for soliciting, the requirements are a lot more demanding. There will continue to be an audit which is required of organisations which have revenues of over $250,000. And as you can see, for non-soliciting organisations, that limit is $1 million. So there's a lot more demands being made of soliciting organisations. There'll also be a change in terms of the requirement to file annual financial statements. Soliciting corporations will need to file annual financial statements with Corporations Canada, where they will be available for inspection by the public. And this is, again, increases the availability of financial information, increases the accountability to the general public. In some ways, it mirrors the service which is already provided by CRA. But as I said, the idea is that these financial statements will always be prepared under GAAP, whereas the CRA ones, there was not that requirement, and the information which may have been made available to CRA was sometimes more limited. So in theory, it increases the amount of information that's available. Now, just one thing to say. At the minute, there's a relatively small level of organisations who are incorporated federally compared to provincially. So there's relatively few organisations in the grand scheme of things who these changes will apply to. However, it's expected that the provincial rules will also change to be brought in line with this, although that is still to be seen. But the idea is that there will be an increase in the level of demands that are made of those organisations who are in receipt of public funds.
So for starting with an audit engagement, as Sara mentioned, an audit engagement has to be completed by an individual who is appropriately trained. That means that they have the specific training that's required, and in each of the provinces, that type of training or the individual who can perform the work is different. I would certainly say here in Ontario, the chartered accountants are signing off on the audit opinions at this point in time. So that's one piece. It also has to be an individual who's independent, as Sara mentioned. So those few considerations. And an audit is a test of the internal records of the organization so that an auditor can attach opinion at the front of those financial statements that speaks to the fact that the financial statements have been prepared in accordance with generally accepted accounting principles, as Sara mentioned, and that they are fairly stated. Now, what do I mean when I say fairly stated? There's a concept of materiality, and the concept of materiality is at what point in time a reader of the financial statement would change or alter their decision when they're reading those financial statements if there was an error that was not adjusted. So if you think about that, that's very conceptual. There's a lot of readers of the financial statements. There are financial institutions, there is the board of directors, there are specific donors in the public, and some of the materiality factors could be $1 versus $100,000. So it's taking into consideration your organization and that reputational risk as well. Now, the formula that is used by auditors is typically 0.5% to 2% of the assets or the revenues, depending on the drivers in the organization. So that's just a gauge that we use as the maximum materiality level. Now, in terms of what makes up an audit, what types of procedures, just to give you a little bit of a sample. This is certainly not an all-inclusive listing that you see here. Performing an audit is taking a look at the overarching controls in the organization. And when I say the overarching controls, it's taking a look at the reporting, the communication, and the monitoring, and ensuring that those specific controls are in place. So it's speaking to whether the board of directors is functioning and the appropriate skill sets in the board of directors. Is there an audit or a finance committee in the organization? And not all organizations have that additional committee. Usually the board in smaller organizations accepts that responsibility. And it's also taking a step back and taking a look at controls versus substantive procedures. So as an auditor coming into an organization, we can choose from our toolkit of tests to be performed. And control tests are looking at authorization. So for instance, there's a control in the organization that only persons X, Y, and Z are able to sign off on checks. So that is a specific control that can be tested. A substantive test is going to third-party documentation or third-party evidence. So it might be sending a confirmation to the bank to confirm the bank balances or the investment balances. It could also be going to an invoice to support that the number that's been reported in the financial statements is accurate and is complete and it's in the right time period. So those are the types of control versus substantive procedures. And we choose test samples, and those test samples and every auditor's toolkit is going to be chosen differently. It might be chosen based on risk. It might be chosen based on a representative sample of items in a specific line item, such as accounts receivable. So the tests that are actually performed are very subjective to who is doing the work, and the number of tests are also very subjective to who is doing the work, and those additional elements in terms of taking a look at the controls in your organization and how you monitor your financial reporting. Now, when I speak to controls, just to add a point there that it's not operational controls. So your auditor's not coming in and taking a look at all the controls in the organization of all your processes. This is very specifically to put an audit opinion on the front of the financial statements, and therefore it is looking at financial controls. Now, additional items that we do perform: inquiries, so speaking to management, speaking to the board of directors in terms of what the sensitivities may be, inquiring of significant transactions in the organization during the course of the year and how those have been accounted for and reflected in the financial information. Also taking a look at the minutes, because the minutes do provide significant amount of information when a board has been discussing specific topics and approving agreements, etc., and ensuring that we have received those as auditors and we've evaluated how those have been reported. And a really good example of something that might occur is in an organization if the banking agreement has been refreshed with the bank. We may not necessarily see that until we're looking at the minutes or management has advised us that that has occurred, because it's not always a document that is readily available or provided to us from the bank when we're confirming the bank balances. So the next item is review. So that's moving from the audit and the tests that we perform during the course of an audit to a review. So an audit, as I mentioned, was saying that the financial statements are fairly stated. A review is one step lower, and it is saying that the financial statements are plausible. And what I mean by plausible is that nothing has come to that auditor's attention that would cause them to believe that the information that has been reported in the financial statements or in the notes to the financial statement, that there is incorrect information there. So the types of procedures that are employed are definitely to a different standard. And just to add, an audit is really looking at inquiry with management. It is looking to see that there is analytical information behind the financial statement, so that there's some trend analysis discussions and that there is support in the organization, and when we're speaking to management, that that information appears to be reflected in the financial statements. And it is also taking a look at a few additional pieces that we'll speak about on the next slide in terms of our procedures. So as I mentioned, this is what I would say is negative assurance. It's just indicating that there has not been an item that has come to the auditor's attention that has not been appropriately reported in the financial statements. So that inquiry and that discussion and that analysis is looking to ensure that the organization has support behind the numbers. It is not inspecting that information. It's not taking test samples. It is not verifying information to source documents. So there's a clear distinction between an audit and the scope and the procedures that are performed during the course of an audit versus a review. Now, the third type of report that an auditor can issue is a notice to reader. And this is a compilation engagement. And a compilation engagement is specifically that you have received information from management in the form of financial records, and it's typically a trial balance. And that trial balance is organized in such a way that we've set up a balance sheet and an income statement. Typically, no notes are included with that type of financial information. And a notice to reader is attached. And a notice to reader really says no procedures have been performed on the information that's included in the financial statements. There has been no testing, and the reader is cautioned that it may not suit their purposes. Now, in terms of the procedures, there's, as I mentioned very simply, there are no procedures in a notice to reader to validate that information. So it's simply the ability to perhaps attach that information to a donor who might be looking for your financial results, but not looking for that level of assurance from an audit perspective. It could be to attach the information to your tax filings in order to support that financial requirement. But it is not evaluating or providing any assurance that the information is accurate, complete, and it is correct. Now, one of the items that Mark had asked us to talk about was the cost and the factors affecting the cost. And we don't have a magic slide in this presentation that's going to pop up and say an audit costs a certain amount of money, because there's a significant amount of decisions and factors that go into evaluating the costs. And we have listed out a significant number of those considerations that we take into account. But certainly, number one is the quality of the information. So the quality of the package that the financial individuals in the organization are pulling together in order to support the financial statements. And that is ensuring that the information is available, it is clearly accessible, it is up-to-date information, that it supports the numbers that are in the financial information. So all of those specific factors are taken into consideration. Certainly the volume and the size of the transactions. If an organization has, it's a private foundation, they have a few private donors that give to that foundation and then they disperse the money, that's very different. It could be at $100 million. But that's very different than going into an organization where that $100 million of donations are made up by, thousands of donors. So the level of testing depends on the volume of transactions in the organization as well. As well, in terms of other factors affecting the cost, is the level of preparation. And typically what we do as auditors is when we've looked through a set of financial statements, we can develop a list of items that we would anticipate management would have available in order to support the financial information. So that list of information may be bank reconciliations, It could be copies of donor receipts. It could be copies of banking agreements, etc. So as we're reviewing the financial statements, there are very specific items that would support each of those line items. And as well, the basic information being available in the form of invoices that have been reported in the financial data. So that level of preparation and availability of information can change the amount of time that is spent during the course of an audit quite significantly. So if that preparation is prepared when we come in the door in terms of performing an audit, it is readily available, management's available to us to ask questions, and that's fairly smooth. But if you go into an organization, and this happens quite frequently if there's a significant change in management, or the information or the paper trail may not necessarily be there, so that takes some additional time. And it takes time to ensure that management understands what they're looking for, as well as what they have to have available when the auditors do return to perform those particular procedures, perhaps where the information wasn't available. Now, as Sara mentioned, an audit is in accordance with auditing standards. So there's very specific auditing standards. There are standards for a review and there are standards for a compilation. So if there are any significant changes in those standards, or if the organization has changed their accounting policies, so the accounting policies that are noted in the notes to the financial statements are areas of choice, and the organization has chosen a specific policy. If those policies should change, there's certainly some additional work that has to be performed because there are some additional disclosures and some other considerations from an auditing perspective. So that could be something that could change in terms of the cost of an audit. And there are developments that are forthcoming in terms of not-for-profit accounting that will be around in perhaps 2012 or later that will change potentially the landscape for not-for-profit accounting, which is what we've referred to as the 4400 series. And that's a specific set of handbook sections that are generally accepted accounting principles for not-for-profits and charitable organizations. So all of those items could develop into some additional time for management and additional time for the auditors. So a couple of additional items here that we've listed. If there are any significant issues that we run into during the course of an audit, or issues where management has run into a specific situation that they have to deal with, that could be a one-time or an unusual complex transaction. It could be changes in those standards, as I mentioned, not only those accounting standards that you would deal with in preparing your financial statements, but the auditing standards that we live by when we're performing our work, and those do change from time to time. And that client assistance listing that I previously mentioned. So what most auditors do is to ensure that if there is any differences in terms of expectations, to have those conversations up front, because oftentimes there is some additional assistance that can be provided in assisting management in developing those underlying working papers that are required to support the financial information. So turning from what we take a look at in terms of pricing an audit or a review engagement, moving to what you would consider when you're making a decision. So if you're not required to have an audit and you're deciding whether you do want to have one or not, there's two aspects, and certainly one is the financial resources of the organization. Many organizations are unable to support the cost of an audit or do not want to support the cost of an audit because the monies that they're bringing in are for their charitable purpose. So that's one consideration. The second consideration is the time commitment. And as you can imagine, those different procedures between an audit, a review, and a compilation require different amounts of time. And it's not just our time in terms of those audit procedures, but it's management's time in terms of preparing those underlying records and ensuring that they're available and supporting the auditor when they're in the field in terms of addressing questions. So certainly the financial cost and the time and the resources of the organization are two of the critical decisions that you do need to make. Now, on to the value. So the benefits of having an audit. We've heard a lot during the course of yesterday as well as today talking about governance and talking about transparency. And this is one piece of that. So it's not the be-all and end-all of being transparent with your donors, but it is a starting point. Many donors, as we heard, are very sophisticated here in Canada in terms of being able to read financial statements or being able to take financial statements and interpret what they feel is appropriate from the financial information. And a lot of individuals who are donating do understand the basic concept of an audit and what that might entail. So it provides that additional credibility, it provides additional comfort, not only to the board of directors, your audit and finance committees, but as well as to the donors and the other stakeholders in the organization. So oftentimes, as Sara mentioned, the bank may require an audit, and that's so that they can evaluate and have comfort in your financial information. So that could be a potential user as well. There's also the additional benefit of our communications, and there are very specific requirements of an auditor to communicate with the board of directors or a committee, such as the Audit and Finance Committee in the organization. So that's really stepping back and having a discussion at the planning stage as to what sensitivities they may have, what's keeping them up at night, those individuals that are in charge of oversight of the organization. But it's also coming back to them at the end of the engagement and speaking to very specific items. So it's talking about any adjustments that were observed during the course of the audit. That is important because if there are a lot of adjustments, then you know that there are some controls that may not be functioning in the organization during the course of the year to ensure that the information is accurate and complete. And what that could mean is that management is making decisions that they wouldn't have otherwise made if those adjustments had have been made at the time of those transactions occurring. It could also mean that there are additional areas that are red flags. So if there are adjustments in particular areas that could lead to an indicator of fraudulent or illegal activities in the organization as well. We've heard some information about corruption as well over the past 2 days. But also the qualitative aspects of talking to the board of directors about the accounting policies, understanding how the accounting landscape is changing. So talking about what we foresee in a couple of years in terms of the accounting rules themselves and how you can be proactive in addressing them now as opposed to addressing them later when your resources are quite stretched in the first place. So those additional conversations, the opportunity for the auditors and the board to meet, provide that additional level of comfort and provide that opportunity to have discussions and evaluate what an audit is all about, and for us to perform procedures that the board of directors may also be looking for us to perform. Now that covers off as well this next piece in terms of governance, but I would say that there's a lot of organizations that do see some of those audit procedures as being best in class and understanding what best in class is in terms of other organizations. So as auditors who specialize in the not-for-profit sector, I would certainly say the one benefit that I know, and I'm sure Sara would comment on this as well, that we can bring to the table is understanding what their best practices are and being able to reiterate those best practices to our other clients so that they are able to expand upon those efficiencies. So that's what I mean in terms of the best of class governance and the comfort level that comes with that as well. The other piece that is specific to management and to the board of directors to a certain extent is that financial literacy and that additional discussion of key components that are critical accounting components but are very complicated, and where you get into tracking of endowment funds, tracking of deferred contributions. So some of those areas where there are donor restrictions, that can get complicated, and understanding the financial consequences behind that and the procedures and policies that you can put in place and best practices is the financial literacy side that an auditor can also bring to the table in terms of those discussions. Now, the last item that I'll mention just very briefly is a management letter, and a management letter is used differently by different organizations. Typically, it is where there are significant internal control weaknesses that have been identified by the auditor. So these are serious issues that could lead to the financial statements or may have already led to the financial statements being materially misstated. So those types of observations are brought to the board of directors level, and they are discussed in terms of what the observation was, what the implication was on the financial reporting, as well as recommendations of improvement, not only of the control itself, but talking about the adjustments that were made. So that type of management letter, although is more negative because it comes up when there are issues, certainly brings benefit to the organization in identifying where there are gaps and how to improve upon them. Now, there are a couple of types of special purpose reports, and oftentimes these are audit reports, but audit of financial information, not an audit of financial statements. So there's a distinction there. And it could be a funder that has provided specific funding for a very specific project and they want to know how that was spent. So that's extremely common. It could be a wage subsidy report as well. So that is simply a statement of revenues and expenditures for that specific funding. So what happens is that when we're auditing the financial statements, we are auditing those financial statements at the entity level and at that materiality level that I mentioned, at that total level of the entity as a whole, not that specific funder's money that they have given to the organization. So there's two very different levels of testing and procedures that are required there. And then the last item that an auditor can assist with as well is the income tax filings. So whether it's a charitable organization filing the T3010B or a not-for-profit organization filing the T2 and the T1044 component, we can assist with that. Well, I will go over a couple of the common misconceptions. First one we've worked on quite a bit in terms of talking to boards of directors, but there used to be a lot of consideration that we tested 100%, and we don't, and it's impossible, and you would never want to pay that fee to have an auditor in testing 100% of your records. That would take a significant amount of time and would not be of cost benefit. So as I mentioned, we do test sample, but there are individuals that still do believe that there's specific areas where 100% testing is employed. Now, in terms of consideration of fraud and error, auditors are watching for indicators. We're watching for red flags, but we cannot always detect a fraud or an illegal act, and I'll give you a good example. If we go into an organization and we're looking at a control that the manager of procurement is the individual that has to sign off on every single item that is procured over $100,000. Well, we can go and we can look at those signatures on every single paper, but if someone forged one of those signatures, we won't identify that, and typically management won't identify that. So there are areas of fraud that we can check for, and we can do specific procedures to find issues, but we're not going to identify all of them. Now, as well, in terms of our overall approach, sometimes an auditor may choose to perform fully substantive audits, so just vouching or looking at third-party documentation or confirming with the bank and not look at those specific controls in the organization. So that's a dialogue that you do need to have if there are any sensitivities in specific areas, or if you have revamped your processes in a specific area and you'd like their commentary on any gaps that they do see. So just talk to your auditor up front, and that is part of that planning discussion where they're telling you exactly what they're going to do in each specific area of your financial statements, so that there's no misunderstanding in terms of the procedures that they perform, or that they don't perform something you'd like them to as part of their audit. And as well, that the management letter commentary, it's only focused, as I mentioned earlier, on the negative. It is only focused where there are observations that need to be improved upon, and only on financial side as opposed to operations. So that's a key component to remember as well. And an operations audit of the organization looks at every single control over every single process, not necessarily the information that's just leading to your financial statements. And that is performed by a different group of specialists. And as a couple other items here, accounting assistance versus auditing. Many organizations keep their books on a cash basis as opposed to generally accepted accounting principles. So when an auditor does come in and there are adjustments to be made, sometimes that's accounting assistance. It's not necessarily that they are performing procedures to validate what you have in the financial statements, because they've gone that one step further to assist you in preparing that underlying financial information. So that's the accounting assistance side. That also leads into that financial literacy, the understanding, and the education component that comes along with it. And I guess the last one that I'll touch on is the testing threshold. So as I mentioned, there are testing thresholds there. It's not 100%. That dialogue does need to happen in terms of how your auditor is going to approach the audit and what they're going to focus on. So don't have any expectations that something will be reviewed fully unless you've already had that dialogue, or the auditor's already observed that and identified that to you.